Hello and welcome to this week's Market Matters weekly video update. I'm Harry Watt, joined by James Gerrish for Thursday, the 15th of September today. James, it's actually been a couple of weeks since we've sat down and spoke together in front of the camera. So we're going to kick things off with performance. I know we're a few weeks into September, but how did we go last month across the portfolios?
Yeah, August performance right across the suite of Market Matters portfolios. So, the market was pretty choppy in August. The S&P ASX 200 in accumulation terms actually added 1.18%. That was against a backdrop of global equities that were lower. So the S&P 500 that was down more than 4%. So we did better than our overseas counterparts. The flagship growth portfolio was up 2.87%. So did very well relative to the market. Also important that we were in reporting season, so that talks favourably to our positioning. The income portfolio was slightly lower, down 20 basis points on the back of sort of that move out of the out of the more value orientated stocks. The emerging companies portfolio did well. It was up over 3% for the month, which was well above its small ords accumulation index benchmark. International equities, I just spoke on the backdrop of the S&P 500 down 4%. The portfolio was actually up nearly 4%. So that was a really strong result from the international equities portfolio. And then the ETF portfolio put on about 2.8%. So all in all, it was a pretty good outcome for August across the suite of Market Matters portfolios, with the big backdrop being US interest rates and global interest rates moving higher following the Jackson Hole Symposium, where basically the Fed chair said that they're going to have to raise rates more aggressively than the market had been positioned for.
And that actually didn't provide a headwind for growth equities in Australia, at least. But taking things back to the flagship growth portfolio, James, we've made a couple of changes towards that effect, really, buying Seek and buying REA in the last week or so. Just run us through your thoughts on these two companies and why we've started to add them now.
So I'll start with the macro, our view in terms of the macro backdrop. So US 10-year bond yields are at nearly 3.5%. So we think that's going to could well be an inflection point for bonds. Obviously, the market is of the view that interest rates are going high, but it's positioned that way. So the market is now aggressively positioned for further interest rate hikes. We think that 3.5 in the 10-year could cap that move. If we see an inflection point there, and you may mention it before, that even though interest rates rose, bond yields rose, those tech stocks, those high valuation stocks actually stayed pretty well composed. So we think that's a bullish sign. So that's the macro backdrop that we're operating in. In terms of Seek and real estate, two really high quality companies. We've added 3% into both of those positions in the flagship growth portfolio. We want to be targeting these companies that are real. They've got real earnings that have come back in valuation pretty meaningfully, but they've got really strong positions in their markets and all the things you want to be targeting as an investor, but a more reasonable price than you could have got it 12, 18 months ago. So 3% positions, we're establishing it. We'll increase that over time if they do what we expect they're going to do. They were good additions to the flagship growth portfolio against the backdrop of we're carrying high cash. So into this market decline, we're carrying a reasonably high level of cash, and we've started to spend that, but more to go. So expect some more alerts as as things present themselves in the coming weeks.
Specifically on REA, just quickly, James, they've obviously got a bit of a link to the property market. There's doom and gloom out there, people thinking that there's at least a 15% drop coming in the local housing market. How does that play into their earnings? Is that potentially not as bad a headwind as some people would think?
Yeah, volumes are really important for them, and also it's harder to sell a property, so you've got a greater level of time on market. Plus, they've got to put more initiatives in place to actually catch the buyer's attention. So all of that feeds positively into REA's earnings. So it's not around prices declining. That's not a big impediment to REA. It is if it creates a lack of supply, a lack of new listings, etc. But that's not the case yet, and I doubt that will be the case going forward. So the market's pricing that stock on a reasonable multiple for the level of growth we think they're going to deliver over the coming years. So that's why we bought it.
Yeah, they're not taking a clip on the sale price. They're just there to see the volume. That's
Absolutely.
it. For the income portfolio, James, next we've also made some changes there. We added one hybrid. We've also added AGL back into the portfolio after a bit of a pullback there. We're tipping more cash into this market here. Is that the right thing? We are looking for income, so you've got to be invested, I guess, in that portfolio.
Yeah, we ran cash up pretty aggressively in this portfolio, given the context that it is an income portfolio. We've gone and spent, put 5% in a Westpac hybrid. So if you think about hybrids, first of all, given where the bank bill rate is and where it's going to go and where margins are, we're now getting sort of circa 7% on a 5-year hybrid. So this portfolio has got a cash plus 4% benchmark. So these we can take less risk to achieve our portfolio objective for now, which is really great for income investors. You want to take. Yeah, it's an important concept here. You don't want to continue to add more, take higher risk than you should be taking. You should be, positive that the market now is throwing up more lower risk, more moderate risk income opportunities that are delivering that yield outcome that you're seeking. So we added the Westpac hybrid in there. We also bought AGL. So we sold that sort of near $8.40. We've bought it back sub $7. We think there's still more corporate activity play out. We're bullish on the value of their underlying assets. We think they're going to unlock the value somehow. There's a couple of ways they can do that, and we've got a few scenarios that we think could play out in respect to that, but we think the risk reward stacks up below $7. So we added that about $6.85 or thereabouts. Harrison, with a smaller 3% weighting.
Yeah, definitely. Onto the emerging companies portfolio,
which is your portfolio. It obviously had a good month, up a bit over 3% for the period. Take us through some of your thinking there, because we did run up cash, but we've run that back down in the last little while. There's been a couple of really good positions in there. Lavisa would be one I'd call out. And Select Harvest is doing really well today.
Yeah, definitely. I think the portfolio has done really well since the end of financial year, James, as a flush of cash going towards those growth equities like we've already spoken about. Portfolio did really well through reporting season. Lavisa, like you said, that's sort of been non-stop one way going higher. Lately they went ex-dividend yesterday, which didn't help the selling yesterday as well. I think I've heard a number of people now saying that they underappreciated that store rollout, and that's now playing into the price. We'll see if it could go on with it. It did sort of crack a new high recently, and it might push up again, but we'll keep an eye on that position.
So it's a pretty simple business model.
Yeah.
You sell jewellery that costs you a couple of cents to make for $5 to $10. Your store fit out costs you basically nothing. You roll those out and it works to a consumer that's less price conscious, less sensitive to interest rates, etc. My daughters love that shop.
Yeah, I know your birthdays. Every time a birthday rolls around, you're in Lavisa. They're running at sort of 80% margin, so they can afford to take a bit of creep if that cost pressure does come in. Store rollout takes them basically 3 months to pay back as well. So, at a new store, it takes you 3 months to pay back the cost on that, and you're earning cash from there. Pilbara was another one that we've done really well out. That's cracked a new high as well. All lithium stocks have been moving one way, except for Lake, basically, I think is the only one that's pulled back lately. But today we've seen Select Harvest, the one we're going to call out today, is up 15% on the back of a crop update. From these guys, there was a lot of issues and concerns around the varroamite issue with bees and how bees would be able to move around the country. Select have come out today and said that they've got their minimum that they need to reach their harvest. They're forecasting about 30,000 million tonnes of almonds in 2023.
30,000 tonnes, yep.
30,000 tonnes, not million. And that was a slight downgrade, but there was a reasonable short position in the stock banking on a bigger downgrade because of that B issue, and that's sort of now released. It opened only a couple of percent higher, and it's rallied since then as that short squeeze has gone on as well.
Yeah, it's an interesting stock select, Harvest. So,
Definitely. They also talked about almond prices being really well supported. California is the biggest grower of almonds in the world. Is massive in terms of that almond market, and they've had a massive drought, which has sort of squeezed the supply of almonds, and it looks like that one's just going to continue to move high. People need to eat. Almonds is a great source of food, and there's going to be that demand there anyway. So if that supply continues to get squeezed, we'll see that price move higher, and they look like they've done well in terms of their production numbers. So we're happy to be there at the moment. The final portfolio we're going to talk about today, James, the international equities portfolio. It's done really well, like you said. Those growthy names internationally have held up really well. We did make a change lately, I think last week, was it?
Back end of August, we made a couple of tweaks to that portfolio. So we just trimmed out of the trade desk, which has been a great position for us, but just reduced that, given it's a really volatile stock. And what you see, a lot of these tech companies, because a lot of the remuneration can be share-based, when they come out and report numbers, they then you then open the window for staff to go and sell some stock. And that's what we often see with some of these. So we got ahead of that. So we trimmed some trade desk. We also went in and bought Snowflake, which is SNO, over in the US. That's done well for us. And there's a couple of other tweaks that we're contemplating at the moment. We've written recently about Disney. We really like Disney. Lululemon, the activewear that you tell me you wear, Harry. So we like Lululemon as well. That's a stock that is well and truly on our radar. And we've got a couple that I also wrote about Blackstone yesterday. So they're the private equity company that took out Crown. Obviously, funding costs play into the private equity model. So when you've got sharply increasing interest rates, that can be an impediment to deal flow. So these guys are down 26% over the past 12 months. So I think that is when interest rates turn or we get some stabilisation in bond yields, that's one to go and add to the portfolio as well. So a great operator, big footprint right across the alternative asset space. So Blackstone is also on our radar for the international equities portfolio. A couple of things we're looking to tweak out of that portfolio, potentially Tesco, and we've got a position in Bubba, which is not Alibaba, that has not done well for us. We may well trim that and cut that out of the portfolio as well, Harrison. But all in all, I sit back and August reporting season, it's always good to get a handle on the companies that we own. We've certainly done that. We had one or two landmines, but overall it was a positive outcome in terms of the portfolios that we're running and the outcomes relative to those benchmarks. So I was happy with that, as no doubt you would have been.
Yeah, it was actually a reasonably well session through reporting season. We have started to see analysts sort of increase their earnings forecast for 2023 as well. A bit more certainty around that is always positive for equities.
Absolutely.
That's all we've got time for. Good to be back in front of the camera, and as always, keep an eye on the Market Matters reports.